as far as our speaker for today, many of you guys know Todd. He's been around the block, so to speak, right, Todd? He's a CPA. He's also a CVA. He's partners with Jackie in Tab, New York. He's valued over 350 businesses, and that's counting. Since 2000, he teaches and coaches leaders in real world experiences, how to run a viable company, how to scale their business, and how to run a company that can be bought or sold or transferred internally or externally. So he has a wealth of experience. He's also previously taught as a graduate school professor, professor of management and leadership, and as well as an adjunct professor of accounting. He's also involved in a lot of charity work as well. So I'm very pleased to introduce Todd Ringler today as our spotlight speaker. And Todd's topic is going to be on factors affecting your business valuation. He has a handout which was shared in the chat. I'm going to share it again so you folks can actually access it. Todd, I'm going to kill my slideshow and you can you're free to share yours. You can continue on with your presentation. So Todd, thank you again for being our speaker for today, and welcome to M&A Network Roundtable.
Oh, Kyle, thank you very much for the invitation. Anthony, you made me feel old. I can't believe that you started NYBB in 2003. So that's a long time ago, and we've known each other a lot longer than that, I believe. So, business value. What's my business worth? You know, that's the quintessential question that every business owner asks. And as many of you know, they all think that it's worth more than it actually is. But today what I'm going to do is kind of do big picture on what business value is. I'm going to discuss a little bit about different value worlds, because there are very different perspectives from where people are sitting in terms of what the value of a company may be. I'll give you a quick crash course in how we calculate value, talk a little bit about getting a business valuation done. And it is a business valuation. A lot of times I hear evaluation. I was on a call with an attorney the other day, and she kept saying evaluation, and I kind of had to correct her. I didn't feel comfortable, but it is a valuation. We value the business because it has both tangible and intangible aspects to it. And then we'll get into the value drivers, and I'll show you a tool that I use called Core Value, where we can look at 242 data points in a company to help improve and develop a growth plan to improve that business value. So to the group, I'd like to just, as a throw out question, why are people in business? Unmute yourself, throw it in the chat, whatever it is, but a quick answer. Why are people in business? Anybody?
Make money.
Make money.
Make money, right? Is that the only reason though?
Well,
or is that the intentional reason, right?
To provide value to my stakeholders.
Value to stakeholders or shareholders, right? In the public world, it's shareholder return, it's dividends and asset growth. So, sometimes people are altruistic. They find a product or a service that help a niche, and they'll go after that. But ultimately, we're in business to make money and to create, especially for small, mid-sized businesses, to create a lifestyle for the owner and for the leadership team to be able to do what they want to do, live the life they want to live, and have the income to support that life. So, that's me, no big deal. I like to call this, what is your business or your client's business worth, or why? And, to get right into it, there are multiple value worlds. And what I'm really going to talk about today is fair market value, owner value, and then this thing called enterprise value. But when you look at value worlds, what's an insurable value? What's an intangible asset value? What's the collateral value if we're talking about insurance? Are we in the right levels of indication? And enterprise value is really a calculation, and I want to read this because, to get it right, it's a calculation of the overall current value, sort of like a balance sheet approach as opposed to equity value, which is really more of a profit and loss income statement approach. And, Anthony's hidden there, but Anthony, feel free to chime in if I say something that might be a little bit, a little bit that's not in your world. Anthony's also a certified valuation analyst, and we've had many conversations about business value. But there are many different value worlds. And a gentleman that wrote the book Private Capital Markets, Robert Slee, has an article that I'll be more than happy to share if you email me about the transfer value of a business is based on what the owner is looking at. And all of these value worlds come into play. Obviously, estate and gift planning and those kind of things, you want to make a lower value as opposed to, the return on your equity is a higher value. A synergistic acquisition ultimately is going to be a tremendously high multiple. But all the time, and it's kind of an interesting, another question here is, business owners generally don't know the value of their business. And it's interesting that initial founders, do you think that they think their business is worth more or less than what it really is? Just quick, do we think it's worth more, initial founders, or do we think it's worth less?
Is that a trick question?
Not really.
More.
Interestingly enough, people that find companies and that are older now, these baby boomers, sometimes they have an inflated idea of what their value is, but more often than not, and this was Bain Capital did this survey a number of years ago. First generation or founders think that their business is not worth quite as much as it is, where the second generation thinks that it's worth way more than it is. So if you can take a look at that or think about that, and it goes pretty much on the bell curve. It's the standard deviation of what a business owner thinks. Those first generation founders definitely think it's a little bit less. The second generations think it's way more valuable. So just something to think of when you're dealing with your clients and the conversation of transition or sale comes up. This is a slide to read, and it's kind of interesting because the IRS actually did something good back in 1959. They gave us this definition, and there's some key points which are bolded, right? Willing buyer, willing seller, not under a compulsion to buy, and the most important part, which is what the conversation was earlier from Jeff and Doug, who was doing and Roy rather, reasonable knowledge of relevant facts. And that's where the due diligence comes in, both from the buyer side and from the seller side. I mean, I believe that, Kyle and Anthony recommend that a seller does a due diligence before they are getting ready to put it on the market, because you'll find the things that the buyer is going to find and hopefully correct those things. So the IRS did this very good piece of writing in 1959, and it holds true today. So let's talk about value. Everyone talks about, what's the multiple? And this is the simplest form of understanding business value. It's the earnings times the multiple. And the earnings really comes down in the small to medium business world, the seller's discretionary earnings. How much does that seller actually get at the end of the day in their bottom bucket? And, not that anyone has ever seen this, but, the cars may be running through the business. The American Express card with the family vacation may be running through the business. My favorite story, I was valuing a natural gas distributor in South Jersey. He was pulling 6 to 10 trucks out of Elizabeth every night, tractor trailers, a very, very large company. And he had this thing called Spectra expense. It was a monthly $4,295. And then May, June, July, August, September, sometimes October, anywhere from $25,000 to $50,000 was in this. And I'm going, what's this Spectra expense all about? He's like, it's marketing. Don't worry about it. And I'm like, Jack, I really want to understand this. I had an intern. Google was new. He said, let's Google Spectra. Does anybody know what a spectra is? It's an offshore power boat. The super deluxe multiple, right? So wait, it gets better. I go back to him, I go, Jack, what is this really? And he goes, well, you know, I'm like, look, I'm not the IRS, but it's important because you're giving this to your son. We're working on an estate plan, and we want to make sure that the value is at least right on some place. He goes, all right. He goes, I'm in a rich boy club. He goes, there's 10 to 12 of us once a month. We have a lineup and race. And sometimes it's like from the Bronx at the west end of the Long Island Sound to Montauk. We line up, we go. If someone's in your way, you have to stop, you're out. He goes, but it's $100,000 a guy, cash, all in, winner take all.
Shit.
He's running this through his business, and that actually improved the value of his business if we were going to sell it, because it was an estate plan. We let it go, kind of ignored it. But if that a business owner is running some kind of expense like that through their business, it really should be down at the bottom line. So that earnings number would have been increased in this particular instance. And, you know, and he did say he won a couple of times, and, you know, that's the rich boy club. But could you imagine $1 million in cash or $1.2 million in cash at the end of a race? And Jeff's shaking his head, smiling. And I smiled about that one all the time. But these things go on. So value times earnings times a multiple. This is the math, or the pretty equation, you know, for those of us that are a little geeky and like the numbers. And valuation is both an art and a science. This is certainly the science part. So when we talk about earnings or cash flow or seller's discretionary earnings or EBITDA, there's many different terms that we can use to put that amount in there. And we take that cash flow and we divide it by the risk associated with that cash flow stream and the historical growth of the company. So the risk rate minus the growth rate, or more simply, free cash flow divided by the cost of capital less the growth in that free cash flow. Does that make sense for everybody? Just making sure, kind of looking at the group. All right, so this is the educational piece here in terms of value. And, you know, it all goes back to risk versus return. So when we look at risk versus return, you know, you want a safe investment, buy a treasury bill. It's not paying a lot, but you're not going to lose your money. And as we go higher on the risk side, the return gets greater. And these small, privately held companies that we all deal with do have the highest risk, but they also have the highest return. So, you know, you can invest in bonds, you can invest in growth stocks, you can invest in OTC, or you can invest in a operating business, which is what we're talking about here today. So understanding how the risk plays out in this calculation, I'm going to give you a quick example, make the numbers simple. And this applies to where I'm going to bring you next, which is the $1 million at the bottom end of the day. I had helped a manufacturer do a divorce in 2005, about 6 years ago. He called me up and said, my biggest customer wants to buy me and I have no idea what I'm worth. $5 million on the top, $1 million on the bottom. So he was dropping $1 million to the bottom line times some multiple, right? So let's take a look at the math here. If we take that 1 minus the risk minus the growth, and we say that the discount rate or the risk rate is 15%, and the company is growing in free cash flow at 5% a year, we've got a 10 divisor. So the multiple now equals 1 divided by 10, right? And then we've got $1 million times the 10, and we've got a $10 million value. Is everybody following that? A little quick, but that's the basic. Where does that multiple come from? You know, everybody goes, oh, I got a 5 multiple, I got a 3 multiple. And it's way more complex than just this, but this is the simple example in terms of understanding that multiple and where it comes from. So we're talking about expected cash flow. We're talking about the growth of cash flow. And we're mostly looking at the risk of expectedly achieving that cash flow into the future. So those are the factors that get involved when we're dealing with business value. on a valuation calculation kind of scenario. Is everybody good with that? Any questions? Okay. Process. Document request, gather the data, we analyze the data, do some financial statement analysis, and this normalization would be what I had discussed with Jack and his boat, right? That marketing expense really is income to the bottom line. So we'd like to normalize the business owner's cash flow. You know, maybe they own their own building and they're paying themselves a ridiculous amount of rent or no rent at all. We need to build those things into looking at the value of the business. What's the industry like? Is it a growth industry? Is it a stagnant industry? Is it a new and emerging industry? And what's the risk associated with that? We spend a lot of time with the management team, between 70 and 100 questions, usually 4 or 5 hours. It's an in-depth, painful process. We ask questions about every part and aspect of the business, from the sales, the IT, the HR, the legal, the innovation, all of those things. We take a look at comparative company sales. We've got a number of different databases to do that. We develop a market method. Now, that market method comes from these comparative sales. So although no two businesses are the same, industries do have standards, if you will. And we can certainly take a look at other businesses in the same region, in the same industry, with the same or similar types of revenue and owner's discretionary earnings to come up with a market method. We do that analysis. We'll take a look at an income method, and I showed you very simply a capitalization method, but there's a discounted cash flow. If we've got debt and equity in the structure, there's a weighted average cost of capital method. There's a lot of different methods to really peel back and take a look. And we'll often do 1 or 2 of them or more to figure which one is really the most accurate, or as a sanity check for those calculations. At that point in time, we prepare a draft report and analysis. We send it off, we discuss it, and then we finalize that report. So that's the process that happens. My team and I can get this done in as little as 28 days or 30 days. We like to say 5 weeks of business. If we've got all the information and we're moving along fast and we don't have a lot of logjam, oftentimes getting that information becomes difficult and the process gets brought out. But it does take 4 or 5 weeks to get one of these reports done once we have all the information. We do oral reports, sort of the back of a napkin. A written report's going to be on 3 different levels. There'll be like an indication of value, you know, what's my business worth kind of question. I'm thinking about selling it. A specific analysis, which will be a calculation of value. We agree upon certain procedures. We may or may not do a market method. We may only do a capitalization of earnings or a discounted cash flow. And then there's the comprehensive analysis. It's a formal opinion of value. It's required when we're submitting to the IRS for estate or gift tax purposes. And it is a large, long report, sometimes 50 or 60 pages of analysis and another 50 or 60 pages of language. There's a lot involved in it. And then oftentimes we're asked to do a fairness opinion. You know, is the price that we're paying for this stock or this asset a fair price? So that's the kind of Reader's Digest condensed of Value Worlds, the crash course in business value, and the process of getting an evaluation. So what affects value, right? And this is kind of the real important piece of this. From the perspective that I come from, there's two types of risk, or 2 types of things that need to be looked at from a value perspective. There's the market itself. And the market is a systemic kind of risk. You can't diversify it. And if 2020 or 2008 or 9/11 aren't those systemic risk kind of years, then I don't know what is, right? The market gets hit and everyone gets affected. It's systemic risk. You can't diversify the risk. So things like your brand, your margin advantage, your barriers to entry, these 9 items over here, your market share, how different is your product? when 2020 happened, nobody really was able to change any of those risk items. On the other hand, operationally, there is unsystemic risk that we can diversify, risk that we can mitigate, and risk that we can reduce by improving aspects of our business. Those are the most important risks from my perspective, and the things that I help business owners improve, whether it's through the Alternative Board or through Calm Waters Consulting. We're looking at these risks on a regular basis. So, innovation being a very big one, sales and marketing. Are your financial statements buttoned up? How are your customers liking you? Do you even do a customer survey? A lot of businesses don't even know what their customers think about them. Legally, how are you buttoned up? How does your human resources affect things? Operationally, do you have systems and processes in place? Your overall company overview. What is your values? What are your focus? What is your mission? How do you treat your people? All of these things are the things that apply into the value drivers and the underlying value drivers. So the tool that I use for digging deep into this is a tool called Core Value. Kyle's going to send everyone a link to a free assessment. It starts out with an 18-question assessment, 5 pieces of information, your revenues, they ask for EBITDA, but your seller's discretionary earnings, your zip code, your SIC code or your industry code, and your number of employees. So 5 pieces of information and 1 quick question on each of these 18 underlying drivers. What comes out of this is a report that identifies what the value of this company is. So this $5 million company I was speaking about, revenue was $5 million, their profit was $950,000. It fell to the bottom line, a single individual. They were here on Long Island. They were a white room that created circuit boards, green circuit boards, computer boards, and they also upgraded electronic equipment that, like if a screen needed more lights or if there was something technical to do that. The owner worked 60, 70 hours a week and did everything because he was an engineer and he didn't trust anybody to do anything else. Anybody know that one, right? So at the time when we did this, he was looking at a $2 million value gap from what things could be improved. And when we get to it, I'll show you here. So he was in the middle of a rating of about 49. And his biggest critical drivers were his financial, his product differentiation, his growth, and his market. But he had a lot of red flags. And his biggest red flag was his team functionality. So this is the backside. You don't get to see this, but when you do the deep dive, I'm going to pop into the workbook now. There are 242 data points here in every area. So when we go to, where is it? Senior management. His first question, right? Your company has a leadership team and an individual in place that realize the company's vision and mission while helping the owner achieve his or her objectives. Well, he responded to this, we could, but we don't really have a management team or our team is dysfunctional. So now if we were to assess this and say, we need to put a management team in place, we need to put a leadership team in place, you need to be able to let go of some things and bring on people that can help you run the business. You may make a little bit less money initially, but you will make more money later on because, again, do you want to work 70 hours a week or not? And many business owners we find do. But I know a lot of business owners that like to work 35 hours a week and hit the golf course 4 or 5 times a week if they can. So let's just say that over time, we created a good management team. I'm stuck here. And we updated these things. So roles and responsibilities, all right? Not sure what our senior managers do. if we go back and increase or change the answers, we now have an updated organization chart. We now have our senior managers with documented job descriptions. We've got a process. And we also created good communication. We can attach a document. We can add comments to this. But what I've just done is I've improved the value of this business within the backside. And I'm going to do it through some other things here. The team functionality piece, right? Oh, here it was, change answer. Senior management team is a bit dysfunctional. Now his senior management team is a force and drives results. And what you're going to see when we get out of this is that the enterprise value has gone up. Compensation, okay? We're not sure if our compensation is competitive or it's probably lower than what others are offering. When we get into here, we've thoroughly researched the market. We've improved our compensation package to being very competitive. And our compensation package is now performance-based. So when I go back to the dashboard now, we've just increased from a C+ to a B-. The enterprise value went up to $3 million. And if I go back 2 more.
Hey, Todd, I just want to give you a time check so you're on pace. 1:10, probably got like 5 more minutes before we get into some open discussion.
That's perfect. And I'm finishing this up now, so that's perfect time. I'm glad that worked. The value gap decreased, the potential value increased, and the core value rating went up. And that's just on 4 or 5 areas. So what core value does is it allows us to create a strategic growth plan that can be implemented with some facilitation or can be implemented individually. So to go back to this, does anybody have any questions? I know there's a lot of information here, and I know these Zoom things are kind of hard to pay attention to a lot of the time. Everybody all right? Questions, thoughts? All right, so going back to the slides. Operational risk is diversifiable. Market or the whole market risk is not diversifiable, and we really focus on this diversifiable risk in improving the business value. So that was the case study, and what ended up happening is the individual took the number that we calculated initially, went back to the people that wanted to buy him, and they indicated that they weren't interested at that price, which kind of made sense. And slowly but surely, this individual did a few of the things that we suggested, ultimately is still working 60, 70 hours a week and still making a lot of money. And he's okay with that. So if you're okay with it, I guess that's okay. Top techniques for enhancing value. And this comes actually directly out of this wonderful book by Carl Shearer, Equity Value Enhancement. There's 240 things a business can do in this book. But this is just kind of a list of them. The biggest one, enhancing top-level planning, create a course, measure the outcomes at the operation level, using the alternative board, putting yourself on a mastermind group roundtable board, and using core value. The second thing, and Steve's shaking his head, the second thing is utilizing advisors, which is what we all are. So I'm sure many of you have run into individuals that just don't want to spend the money, and that's okay. The next most important thing is creating a benchmark, creating performance metrics, and implementing accountability. There's a lot of other things here. I don't need to read the slide to you. Corporate fat in the budgeting process is a good one. And that's the Reader's Digest condensed version. And I was the player to be named later because Kyle called me the other day and said, my presenter has COVID. Can you present this week instead of next? So this wasn't what I was going to do next week, but it hopefully filled the void and gave everybody an understanding of what business value is all about, how to at least identify how to improve business value. And I guess the floor is open for questions or conversation. Kyle?
Thanks, Todd. I like the presentation, pretty concise, great information, especially like the tail end. The 16 value drivers there that is a lot utilizing core value are there's a lot of intangibles there that can be tweaked to increase a company's value. It's not just all about the numbers. And that way it comes back to the art of the valuation. So you mentioned that you start off with the EBITDA and enterprise value. You can get those numbers from pure figures and working out the discounted cash flow method and whatnot. But these questions here, when you get into the nitty gritty of the business, can really drive value in the respective company. So thank you, Todd. With that being said, anyone has any questions, or if you can relate to what Todd has shared here with a prospective client that you're working with, I mean, the floor is pretty much open at this point.
Yeah, Kyle, I'll jump in. I'll add, I think this is great because this is, that tool especially is a really good way to visualize what I think happens with a lot of deals where the first number comes in at a certain level and then they start to do due diligence. And as they uncover things that are wrong, that sale number gets lower and lower and lower, right? So walking through the planning in advance to understand all of the pieces that will drive value in a business that are beyond the numbers on the tax returns is just crucial to an owner getting what they need and what they want in order to leave on their own terms.
Absolutely agree, Austin. It's doing that due diligence in advance, and I know that Kyle and Anthony do that they really take a look at the enterprise before they put it up there. But that's key, is knowing what you have before you put a sale price on it. It's kind of like going to the Kelley Blue Book for your used car, right? It's the same kind of thing.
Yeah, if you put in that the car's in pristine condition and you get there and it's a hot mess, right? Not gonna work.
Exactly.
I love the addition of risk into the valuation, because when you talk to most people about valuation, they're just looking at numbers, hard numbers, and they're not. I mean, it's not even about intangibles. Risk can be quantified out of uncertainty, and I think risk is a very undervalued value that belongs into the valuation. I'll see if I could squeak that route into the conversation any further.
Yeah, that's a great point, Roy. There's risk in everything. I mean, you wake up in the morning, you might fall out of bed. There's risk in getting up. There's risk in walking out the door. And there's a lot of risk that we don't even think about. What happens if today's the day or tomorrow's the day that everything changes and you're not able to go to work? What happens then? That's the big risk for a lot of business owners that they don't even think, because we're all invincible until we're not, right?
So Todd, just keep this slide up for a second, or if you guys take why don't we take a mental note of it? Because let's kill the slide here for a second. I just want to go around the room. And if you guys take a mental note of that, matter of fact, I'm sorry, Todd, just keep it up. All right.
Okay.
I want to go around the room real quick. Jeff, I know your expertise is in sales. So in Todd's example here, where let's say they need to increase their growth and drive more revenue and work on generating recurring revenue. A lot of what we've seen in the marketplace, a lot of buyers, they always ask, how many contracts, what percentage of the business gross revenue is recurring and so on. Mm-hmm. Enlighten us from your perspective and how you serve your clients, how you can help a client from their growth and recurring revenue issues to help them build value in their business.
Yeah, sure. So there's a number of different ways. Part of it's product line. What products do they have that are self-recurring, that are kind of the easier business, and what do they do to maximize that? What percentage of their business needs to be new and enhanced on a very regular basis to spur interest? And then, you obviously look at the verticals that they sell to. Are they considering all the verticals that are appropriate for whatever the company's products can be, and how they integrate within that? I mean, it's a great tool to look at. I never really thought of the market as being one that you can't mitigate the risk on, but I guess that is really appropriate. We don't have control over that. You work on the bottom line side of it. Sales, there's so many different levers within sales. There's sales process. Do they have a process? How do they go to market? Is there a regimented, documented method for their sales team? If they have a sales team, I'll assume they would do at this moment. How do they go to market? How do they approach client base? Is there a CRM system in place so that there is metrics that can be looked at and viewed upon, particularly leading indicators of what their business is going forward versus what it is in the past? And you can kind of play against all those different levers to try to improve their performance.
Thanks, Jeff.
Yeah, I don't know if anybody saw, but I took the workbook and I actually went to the sales and marketing piece while Jeff is here. And, what are your objectives? Do you have them documented? What are the quality of them? What's your process, which is what Jeff just said.
Yeah.
How's your market segmentation? What about your pricing model? And we, on our last go round at the alternative board, we had a conversation about pricing. I mean, if anybody's talked to a contractor lately, they're like, here's the price, but it's only good for 3 weeks, because in 3 weeks, the materials are going to be more than they were this week. Mm-hmm. And, I'm getting something done here. And he said, look, this price is good for 2 weeks. If you want it, bind it now. He goes, or in 2 weeks, I'm going to probably have to raise your price because my materials just keep going through the roof. The marketing plan and the process, these are all the things that Jeff brought up. What kind of market research have we done? So there's a lot of different aspects within core value and in this workbook under those different value drivers that you can actually peel the onion back to get to the core of it. So,
okay. Hey, Patrick, you want to jump in here from a PEO perspective, and then we can let's go to Jackie right after.
Sure. I mean, I think just touch on a lot of the points about mitigating risk and having the systems in place that are executable and repeatable, I guess, especially the scenario that you outlined with the gentleman that's basically running the business 60, 70 hours a week by himself and has no management team in place or fallback. Is really the story of, if he steps away, what's the business, right? And it really just what the lens that I come into it with, especially with the PEO, is helping put in that infrastructure. And hopefully we're leaning to Jackie to help with some of the people side of things, but having that in place and understanding where the gaps are is huge. That's why we rely a lot on the analytics from a people set as we're advising clients here. So this is great. Thanks, Todd.
You're welcome. My pleasure.
Jackie?
So beyond compliance, because I'll leave that to Doug, there is a big people issue, culture, and what's the culture going to be of, do you understand your culture? Do you have the right people on your bus? Do you have people that if you walk away, can you as the business owner do a whole be away for six weeks without calling in? Meaning, do you have the team that can really run your business in absence of you? Preparing all that, and then do you have job descriptions? Do you understand where the your salary are versus the marketplace? I mean, there are so many things in the HR process that is really interesting and that needs to be planned in advance. Do you want to keep particular people? Should you give them a stay bonus? They go on and on.
Good points there. And I want to have Anthony kind of fill in the gaps. So a lot of what we do is very mental, right? So our job as an advisor is to show the opportunity. So for example, in these scenarios that you guys laid out here, where there may be lack in culture or there may be lack in revenue growth, we want to fully understand the business and where the opportunities for growth are. So we may be dealing with a potential lemon. However, in our role, we have to paint the picture. Hey, all you got to do is this, this, and that. And this company can be a 5X company or 6X company. So Anthony, if you want to talk a little bit about that, because a lot of times the client is like, we tell them, okay, well, let's do all the stuff that Todd said, and we can get you to point X. But most people is like, you're selling the car, it's a used car, it's going to be sold as is, let the buyer do all that. So in the event where the seller does not want to implement a lot of stuff that Todd and Patrick and Jackie mentioned, we have to create a storyline where the buyer can understand what the issues are and how they can fix them and increase the value after they buy the business.
Your job is to put the lipstick on the pig.
You know, keep in mind, Kyle, those are great points. So, you know, the buyer is looking at, I think, 3 factors that I think are really key. Number one, they're looking at net cash flow, right? And, you know, Todd talked about net cash flow and adjusted net cash flow and normalization and all of that. And, you know, obviously, you know, we have to justify all of that to make sure. The second thing they look at is risk in the business. And you guys talked about it from an HR and a legal perspective. But the third thing that really gets them value is scale, right? Can they grow the business? And, you know, they won't pay you for that, okay? But we have to demonstrate, you know, basically almost what is the business plan if you wanted to scale or grow the business? What needs to be done to take the business to the next level? Oftentimes, the client who's our seller says, well, that's their job. And we said, well, that is their job to take it to the next level so they can maximize their investment, but we have to show them the path there. Example, we had a client out east. It was a manufacturing company, a guy named Jimmy, and he had a great business. And he said to us, you know, guys, the only thing is, I think I have 90% of the market covered. And I said, well, Jim, you know what? First of all, that's not a good thing. He thought it was a great thing. Because the guy buying it said, because if you said that to a buyer, he would say, well, what am I buying? Something that can only go down? It didn't make sense. And the second thing is, I mean, he goes, I'm so profitable because I really, you know, I use as few employees as possible. I said, well, you know, the guy who's going to grow the business is going to look at it differently. Turns out, you know, the interesting part is we found that Jimmy did not have 85% of the marketplace because he forgot one thing. He was an old time guy and he really did not use any kind of social media. He did not use any kind of internet marketing. He didn't use any of that. The person who bought it, named Chris, actually was a younger guy and saw the kind of forest through the trees. He's grown the business 200% probably in the last 4 years since he bought the business because he knew. And we had to demonstrate that Jim didn't have 85%. Sometimes the owners don't even realize what they have their hands on. And Todd, one other thing to your point, we find oftentimes original owners come to us and say, who would really buy this business? What would they give me for it? They actually devalue what they've built. And I find the second generation does exactly do what you say. They overvalue it because, you know, they've taken this gem and they want to make sure that they cash out on it. But a lot of times the original owners are like, you know, they're surprised that we tell them that there is a market for their company. So that was a very good point you made there, and probably one that's not known to most folks. But, you know, and the value, you know, in order to accelerate the value and really kind of get them to the next level, we have to really kind of put the business plan together. They have to put a business plan together that really makes sense to the buyer. Otherwise, they're not getting a deal.
Yeah, you're absolutely right, Anthony. You know, an investment banker once said to me, you know, it's worth what somebody's willing to pay for it. You know, and that definitely is a fact. And I always ask, the other question I usually ask is, you know, what's a 1963 Corvette worth? My dream car, right? Well, it depends, right? Is it the one that's sitting in my friend's pool house that's got 2,500 miles on it that's never been driven, or is it the one sitting in the field with the weeds growing through it? So they're both worth something, but obviously not the same amount.
Yeah, I wonder if you and I have the same friend with that pool house vet. But from a tech standpoint, I can tell you that basically I can see tech underlying all of these, right? Because when people think about tech, they think about digital technology, but technology is any process that is put into place that systematizes the business. So because we can't put anything digitally until it's systematized. And Everything here, in order to have a transferable business, needs a system, a mature system underlying it that can be constantly tweaked and improved so that it leads to the things that both Anthony and Todd were talking about, as well as Jackie. And technology, whether it's business process or digitally, all underlies all of that. So whether it's creating a barrier to entry by creating differentiation that doesn't exist through a technology or a process, that's there. Whether it's increasing the product market or the dominant market share, there's technology that can underlie that. Margin, obviously, that can be driven wholly by technology to a significant extent. Innovation is often where technology exists, whether digital or physical or process-based. So from a tech standpoint, there's a significant impact across all these value drivers.
You know, yesterday I worked with an NYBB client to help them put together just some of their strengths, weaknesses, opportunities, and threats. And they really didn't have a clue. And over the hour and a half, really fleshed out. And the whole conversation about it's somebody else's job to figure this out so that they can, you know, it's NYBB's job to sell the business. Well, sell what? And the less you know, and you can tell somebody else what the business is and what it's worth, nobody can sell anything, right? And that's fairly standard. I'm sure Jeff would say you can't sell something that nobody, without any giving the prospect some benefits. So this whole how you're going to grow, how they might do something different is extremely, extremely important.
Great point, Jackie. It's so true. I mean, the client usually is the best salesperson. We need to get that knowledge out there ahead and on paper. And we have to make it as easy as possible for the buyer to understand and relate to and move the process along. So we just hit our 91-minute mark. So I want to be respectful of everyone's time. Thank you again for joining in on another roundtable meet. As we close off, Todd, any last-minute comments? And if you don't mind, you could essentially just close us out this afternoon.
Thank you for the opportunity to speak with you. It's great to see the people that I know. For those of you that I haven't met, I look forward to having a conversation with you. If you have any questions about business value or, you know, business improvement and how I might be able to help your clients, feel free to reach out.
Thank you. And the next meeting is going to be next Tuesday. The link is in the chat if those of you who want to come back. So Todd is not speaking next Tuesday because he spoke today. So we have a little swap going. So enjoy the rest of the afternoon, guys. Have a great day.
Thanks, everybody.
Thank you.
Todd, great presentation. Thank you.
Thank you very much.
Awesome.
Take care, Todd. Good one. Stay well.